Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 30th of November 2020 and we're going to publish two videos today. This one, which is really a time-sensitive video concerning oil prices and China and a dramatic fall again this morning in the price of gold and silver. And the second, which will be published this evening, which will be episode 3 of our Peak Silver series. So let's take a look at what we have to say about oil, China, gold and silver. Okay, first just a quick reference to our gold and silver weekly update published on Saturday and the video we published yesterday entitled Gold Unlikely to Reach $2,000 or Silver $30 again in 2020. Now links to both these videos are placed below. Now first let's deal with oil. We're aware that some subscribers follow the oil market closely and also link various commodities to the price of gold and silver. For a number of weeks we've emphasized that it's our contention that OPEC Plus has been aiming to attempt to drive oil up to or as close as $50 a barrel. This appears to be the sweet spot between most making money and not, while some, like Saudi Arabia, can make profits even if oil was in the $10 to $15 a barrel level. Well, we came pretty close to $50 last week, but didn't quite get there. And this week, OPEC Plus are meeting to determine whether it intends to continue with supply cuts for the next few months or not. This is what Reuters has reported this morning. Reuters article dated November 30th, 2020. OPEC Plus to discuss extending oil cuts or gradually raising output, sources say. OPEC Plus members will consider whether to extend existing oil cuts for 3 to 4 months or to gradually increase output from January during their 2 days of talks that start on Monday, OPEC Plus sources told Reuters. Officials from the Organization of the Petroleum Exporting Countries, Russia and others, a group known as OPEC Plus, held an initial round of talks on Sunday before formal discussions began, but have yet to agree output policy for 2021. OPEC Plus had been due to ease its existing production cuts by 2 million barrels per day from January 2021, but a second coronavirus wave has reduced demand for fuel around the world, prompting a rethink among members of the group. OPEC Plus is now considering extending the existing cuts of 7.7 million barrels per day, about 8% of global demand, into the first months of 2021. A position supported by OPEC's de facto leader, Saudi Arabia, and other major producers in the group, sources said. Preliminary consultations on Sunday between the key ministers, including from Saudi Arabia and Russia, did not reach a compromise on the duration of a rollover. Sources have said talks were now focusing on extending cuts by 3 to 4 months or gradually increasing output from January, a position supported by Russia. Kazakhstan, a member of OPEC Plus, has opposed extending the oil cuts into next year and has instead called for increasing output in line with the existing agreement, one source said. Today's meeting will be difficult, especially if Russia and Kazakhstan didn't change their position, the OPEC Plus source said on Monday. The meeting of OPEC, which precedes a gathering of the wider OPEC Plus alliance, was expected to start at 1300 hours GMT on Monday. Oil prices, which were down 2% at $47 a barrel by 0955 GMT, could fall as much as 10% if OPEC failed to roll over cuts, Deutsche Bank said in a note. Oil had a bull run last week triggered by hopes for a virus vaccine and expectations of a cut rollover. Well, we shall know for certain what's going to happen in the next few days. And we thought it important to make you aware of this so that you can then gauge potential market reaction. Now, the second issue today is the continuing rise of China and its economy. New data published this morning supports the video we produced on the 5th of November, entitled "China, Not Just on the Rise, but Restoring Its Original Power?" A video, we hasten to add, very few people listen to. To be frank, this is both annoying and surprising. There was a time when we produced videos on China, they would attract a lot of listeners, primarily because our followers understood that to a large degree, precious metal prices are significantly affected by what happens with China, and especially silver. It appears to us that either this is no longer the case, or some have swallowed the Kool-Aid that China no longer matters. Let us make it clear once and for all. China does matter. China is important. And if the United States is not careful, within the next decade, if not earlier, China will become the largest economy in the world and will undoubtedly make a bid for the global reserve currency. It is only the fact at this precise moment in time that China does not have a sufficiently advanced financial services system within its own borders that has prevented it from making this bid already. And trust us, because we know that this is the topic discussed by bankers around the world. Now, the West can stop this from happening, but only by fixing their own economies first. Multiple tariffs on Chinese goods do not work in isolation. And there needs to be some waking up by the West and greater awareness by all of us as to what exactly is going on. And simply ask yourself this question, and it is a simplistic question just to make a point. What do you think would happen to gold and especially silver prices if China stopped importing them? And what do you think would happen to their prices if China increased its import of them? Now, please, if you follow no other country apart from the United States, do follow China, then India, and then Europe as a whole. All we can do is try and provide a headlight, but it's up to you whether you follow the light stream or ignore it completely. Back to China. Reuters have reported today that China is rapidly recovering from its fall in trade and commerce due to the coronavirus pandemic and appears to be bouncing back at such a pace it is putting the West to shame. Let's take a look at what they've had to say. Reuters article dated November 30th, 2020. Headline: China's factory activity expands at fastest pace in over 3 years. China's factory activity expanded at the fastest pace in more than 3 years in November, while growth in the services sector also hit a multi-year high as the country's economic recovery from the coronavirus pandemic stepped up. Upbeat data released on Monday suggests the world's second largest economy is on track to become the first to completely shake off the drag from widespread industry shutdowns, with recent production data showing manufacturing now at pre-pandemic levels. China's official Manufacturing Purchasing Managers Index, or PMI, rose to 52.1 in November from 51.4 in October. Data from the National Bureau of Statistics showed. It was the highest PMI reading since September 2017 and remained above the 50-point mark that separates growth from contraction on a monthly basis. It was also higher than the 51.5 median forecast in a Reuters poll of analysts. Quote, the rise in November manufacturing PMI, with broad-based improvements across the sub-indices, suggest the recovery momentum in the industrial sector has become more certain. Zhang Likun, analyst at China Federation of Logistics, and purchasing said. But the results also showed inadequate demand is still a common issue facing firms. We need to consolidate the policy aimed to expand domestic demand. China's blue chip stock market index hit a 5.5-year high following the brisk data. The robust headline PMI points to solid fourth quarter growth, which analysts at Nomura expect to quicken to 5.7% year-on-year from 4.9% in the third quarter, an impressive turnaround from the deep contraction earlier this year. The economy is expected to expand around 2% for the full year, the weakest in over 3 decades, but still much stronger than other major economies that are struggling to bring their coronavirus outbreaks under control. The official PMI, which largely focuses on big and state-owned firms, showed the sub-index for new export orders stood at 51.5 in November, improving from 51 a month earlier. That bodes well for the export sector, which has benefited from strong foreign demand for medical supplies and electronics products. Also helping activity in November was strong e-commerce shopping promotions, which unleashed solid consumer demand and bolstered confidence for small and medium firms. But a surging yuan and further lockdowns in many of its key trading partners could pressure Chinese exports, which have been surprisingly resilient so far. More companies have reported the impact from currency fluctuations compared with a month ago, said Cao Kang, senior statistician at the NBS. Some firms have flagged that as the yuan continues to rise, corporate profits are under pressure and export orders are declining, said Cao. He added, the recovery across the manufacturing industry remain uneven. For example, the PMI for the textile industry has stayed below the 50-point threshold, pointing to weak business activity. Consumer comeback. In the services sector, activity expanded for the 9th straight month. The official non-manufacturing purchases managers index rose to 56.4, the fastest since June 2012, and up from 56.2 in October, as consumer confidence gathered pace amid few COVID-19 infections. Railway and air transportation, telecommunication and satellite transmission services and the financial industry were among the best performing sectors in November. A sub-index for construction activity stood at 60.5 in November, improving from 59.8 in October, as China steps up infrastructure spending to revive its economy. Monday's data also showed the labour market is still facing strains. Services firms reduced payrolls at a faster clip in November, data showed, while factories slashed staff for the 7th straight month, although at a slower pace. The continued recovery reduces the need for further monetary easing, but any shift to tightening is also unlikely, given continued labour market pressure, said Eric San, Greater China economist at HSBC. Now, we hear some dissenters say, this is all very well and good, but we can't trust their figures. Well, in totality, no, we cannot. But can we really trust the figures of other countries too, even our own? What we can trust to some extent are trends. And also, please bear this in mind. Investment decisions are often based on what appears to be the case, only corrected or amended later when the facts actually materialize. PMI reporting is generally trusted within the investment community. And so whether you believe it's true or false, frankly, doesn't matter. It's immaterial, as you and we are not driving global investment demand, but only our own, which, in the main, is determined to some extent by the direction of those in the investment community have followed. Unless you're a complete contrarian, and even then your decisions are based on theirs by doing the opposite. Now, we hope this helps, and later this evening, please look out for episode 3 of Peak Silver. Now, the third issue, Gold and silver continue their falls this morning, breaking through a number of support levels, though gold at this moment is still above that crucial level of 1750. As at 11:05 GMT, gold is down $20 at 1769. That's $1,769 an ounce, whereas silver is actually down 52 cents at $22.20. Now, we placed in our weekly update where we felt key support levels lay, so we would advise, if you haven't listened to that you go back to it, because we're still holding by the figures that we quoted there. If we see silver fall further, then 2160-ish is going to be the next potential resting place. And if it goes below that level, then you cannot rule out $20 an ounce. That's it for now. We hope you found this useful. Meanwhile, thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so that you're notified of our videos as and when they're published, including the one we're producing this evening, episode 3 of Peak Silver. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.